I want to welcome everybody to Financial Statements Unlocked. We have Morgan Herring with us today. She is a new presenter for our SCORE chapter, so we're very excited to welcome her. But before I turn it over to her, I want to talk to you about SCORE, just in case you aren't sure what all we do. So our goal is to share information with the small business community, and we do that in a couple different ways. One is through our website, the sharing of information through the website. There's tons of templates and resources there, score.org. You can download the templates for marketing, business plans, budgets, all kinds of information. There's recordings you can watch, articles you can read, lots of great information. The other way we share information is through our workshops and webinars. We don't have that many during the summer, but we have a few great ones this summer. And then we'll be starting up full force mid-September with a whole complement of presentations. So definitely follow us on social media, check out the website for a listing, and watch for our newsletter for that information. The most important thing, or the most important way we share information, is through our mentorship program. And our mentors are volunteers, and they come to us with a variety of different skills and experiences to share with you. We work with folks that are trying to decide if small business ownership is right for them, if they're in that planning phase, or they're already in business. And people come and ask any business topic you can imagine. And the wonderful thing about SCORE is it is a national organization. So if we can't help you at our chapter level, which doesn't happen very often, we have the district and the national database to reach out to find that specialist that can help answer your questions. A first session is probably about 45 minutes. They're going to want to learn about you. They're going to want to know what your goals are and what your challenges are. And they're going to work with you to put together a plan to be successful. So how do you get a mentor? It's very, very easy. You go to score.org. There's a blue box, put in your zip code, and that will match you to the chapter that's nearest you. They'll then ask you a couple quick questions. There's a free form box. Definitely put in there anything we need to know to help match you to the proper mentor, because that's the information we're going to use to narrow it down to the mentor that has the skill sets that you require to answer your questions. So today we are going to use a Q&A button on the Zoom bar to submit questions. Those are for the presenter. So if you have a question as we move along, please put it into the Q&A. I will answer, put out forth questions that pertain to what she's talking about. Everything else will be saved towards the end, and we will try and get to as many questions as is possible. And we are recording today. Give me 24 to 48 hours, and I will have that posted on the website, score.org/Boston. You're going to go to, as the graphic shows you, the local workshops on the blue bar, and then go down to the previously recorded webinar, and it will be listed there so that you can watch it again in case there's something that you miss along the way. So I'm going to go ahead and close that, and I'm going to go ahead and turn it over to Morgan. Welcome, Morgan.
Hi, thank you so much. Let me go ahead and get my PowerPoint here.
Great.
All right, wonderful. I'm excited to be speaking with you guys today. We're going to be going over financial statements, and this is going to be a really high-level preliminary view for new business owners who maybe aren't familiar with reading financial statements or understanding all three important key documents that make up what people in accounting typically refer to as your financial statements. So today we are going to go over the importance of financial literacy. We're going to take a look at the profit and loss statement, the balance sheet, and the cash flow, and understand how to read them and key features of each report. How do we integrate the financial statements to make it all make sense and tell one story? I also want to review with you some common mistakes that we see at our firm, which specializes in helping small businesses like potentially yours. And then we will answer any other remaining questions. So what is financial literacy? It is the ability to understand and use your financial skills required to make informed managerial decisions with the resources that you have available. So this includes being able to understand your financial statements, but it also includes things such as budgeting and forecasting, understanding savings and investing opportunities, your debt management, financial planning for long-term goals, and credit management. Today, we're only going to be looking at understanding your financial statements. Um, and this is a key step in making informed decisions and being able to have a sense of confidence and independence when you are starting a new business and trying to uh, figure out what the next steps are. With being able to read and understand your current financial statements, it will help you in your budgeting and future planning, um, as well as help make sure that you're in compliance with any regulations that you may need, not just tax, but if you do get into the world of grants or government contracting, there's a lot of things that you need to be aware of to make sure that they don't sneak up on you later on. So the three key financial statements, as I mentioned earlier, are the profit and loss statement. You might hear it referred to as the P&L or the income statement. You also have your balance sheet and your cash flow statement or statement of cash flow. The profit and loss is a summary of all of your revenues, your cost, and expenses during a specific period of time. This is what you typically think of when you think of a financial statement, and most small business owners rely on this document to determine how their business is doing, but it doesn't necessarily show you a full picture. Um, the key components to understand are going to be your revenue, your cost of goods sold, typically referred to as COGS. If you're talking to an accountant and they mention COGS, that's what they're referring to. Uh, the difference between gross profit and net income, as well as understanding your operating expenses. So one thing, and at the end, I have some resources for you. QuickBooks Online does provide a sandbox trial company for you to play in. So if you do want to click around and see some financial reports and try to understand them a little bit better on your own, I do have a link for you there. So that's where these statements are coming from. So we have Craig's Design and Landscaping Services here today. We're going to be picking on Craig a little bit. So this is what a typical profit and loss statement looks like. At the top here, you're going to have your income identified, then your cost of goods sold, your gross profit, followed by your expenses, and then other expenses, and then finally your net income. So we're going to break this down a little bit more and see what we might want to look at. Your cost of goods sold is going to be comprised of expenses incurred that are directly related to your source of income. So in Craig's case here, he probably has things like labor or potting materials, planting materials, maintenance on equipment, things like that, that are directly related to the product or service he is trying to provide. We can see here with the gross profit that it looks like he's doing a pretty good job at managing how much it costs in order to get the income. So he has a total income. The raw revenue is going to be about $5,000. And with only about $230 of operating costs, he is making a pretty significant profit on his services. But this doesn't necessarily tell the whole story. We also need to take into consideration what his operating expenses are, which are typically listed down below. These are what it takes to run your business day to day if you don't necessarily have a job to do or there isn't a revenue stream coming in today. What is still your operating cost? And that can include things like advertising or fuel cost, office expenses, your accountant, lawyer fees, maintenance and repairs, utilities, and rent. At the end of the day, how much are you spending on running your operation? So you have your total expenses listed below, and your net operating income will then be listed below that. So that will be your gross profit minus your expenses is your net operating income. Sometimes in businesses, you will see a section with other expenses or other net income. This can be things like interest expenses. So if you have interest on a loan that you're paying, it might be listed as an other expense because it's not necessarily part of your main operating expenses. That loan will eventually be paid off. It's not a regular recurring cost. And then other income might be something, if you won an award at a pitch competition. You don't want to show that as revenue because you didn't have work directly associated with that money, but it is money that you're putting back into the business. So that would be considered other income. And then finally, you have your net income. And at the end of the day, this is how much money you are taking home. So that will be your gross profit minus your total expenses and any other expenses, and include your income. So here it looks like Craig is working at a deficit of negative $1,900.
Hi, Morgan. I've got a question how this might relate to a nonprofit. When it
Sure.
comes to a nonprofit with the majority of support coming from I'm sorry, coming when the let me just start again. When it comes to a nonprofit with the majority of support coming from a cost reimbursement contract, does that contract count as the income, or is it only income when you receive the reimbursement from the state?
So nonprofit accounting is a little bit different. What we're reviewing here today is going to be a commercial cash-based business. But in that instance, it would be recognized in the top part of your financial statement and it would be considered income. The terminology is a little different when working with nonprofits, and I have my contact information at the end, and I'd be happy to set up a discussion with you later to get into more specifics about that.
Thank you.
One thing that I really like about the profit and loss statement is being able to look at it on a month-to-month basis. The profit and loss resets every fiscal year. So however you have your company set up, we're going to look at this as if it's a January through December company. And looking at the first 6 months here, when you spread it out like this, you can really start to do some trend analysis to make sure that things feel right. A lot of times I tell my clients who are newer to this, even if you don't know anything about accounting, you can still do a basic gut check. Does this make sense for what I do? So looking here at this design and landscaping service, we might see that there is a big uptick in April. Does this make sense for his design income? If it's a landscaping service, we're coming into spring, it makes sense that we might see an uptick there. However, when we see a decline in May in design income, that might give us pause as an owner to say, hey, what happened in May that isn't reflected or that isn't the same as April or June? Because the trend shows it going down when you as a business owner might expect it to go up. It also helps you understand if things are falling into the right periods. So why did I have a uptick in cost of goods sold in March when I maybe didn't see the revenue from it in April? If you're on a cash basis, that might just be because your receivables didn't come in until a month later. So is that income that you're looking at in April truly for services performed in April, or is it from March? So you can start to tell a little bit of a story once you break it down by month and you're able to do some of this trend analysis. Same thing can go for expenses. So you'll see here that when you spread out your expenses, I'm paying $900 a month down here for my rent expense. If, for instance, I'm looking at this and there is no expense posted in rent, did I miss a payment? Is it misposted? Is it miscategorized? It's a good way to check and make sure that everything on a very high level just makes sense to you and your business. I see things like this all the time where something might get miscategorized, but it's very easy to catch once you look at it on a month to month basis because your totals might be reasonable, but on a month to month view, it starts to tell a little bit of a different story. And then finally here, this is your income statement. broken out by month. And you can see at the end here that though up top his gross profit's looking good, he's made $8,400 in the first 6 months. His operating expenses have definitely put a dent in that money. So, does Craig now need to take a step back and look at what his cost structure is for his services? Does he need to be charging more? Or does he need to take a look at what maybe some of his expenses are and cut back? Is where he's renting his office, is that the best choice for him? Or does he need to find somewhere where maybe rent is a little less? Um, so you can see that his uh, net operating income is negative 3,700. But when we take into consideration these other miscellaneous expenses that he doesn't want to necessarily record as part of his regular operational cost, it takes us down even further because we have that big surprise expense there of $2,666 in June. So overall, his net income is not looking too great on a month-to-month basis or overall. The good news for Craig is that he's a newer business owner and he is looking at his financial reports and he sees this. And because there is a trend towards the negative, he can catch it before it's too late. A lot of times with small business owners, you'll see that they ignore their financial statements and operate directly out of their bank account. And as long as there's cash in the account, they think they're doing fine. And it isn't until much later on they look at some of these statements and it turns out they've been trending negative for a while. So being on top of your finances and being able to look at this statement can give you a little bit of a checkpoint to make sure things are continuing to trend. And if there is a dip, why? Being able to answer those questions is very important.
Morgan, I have another question.
Sure.
For the trend analysis that you're using, is it cash-based or accrual accounting? What are the benefits of each method? And can you tell by looking at a P&L what method of accounting they're using?
Okay, so the difference between cash and accrual accounting is on a cash basis, you are accounting for expenses when they hit the bank. So if I buy something on my credit card and it comes out today, I'm going to recognize it today. If I receive an invoice for something today and I don't pay it until August, I'm going to recognize that expense in August. And then the same goes for your revenue. So whenever that money you receive comes in, you're going to recognize it versus having an invoice. You send an invoice out to your customers for services performed in April, and when they pay, all of that money will be recognized in April as well. Cash is a very common method of accounting for small businesses that are just starting out. I see it a lot more for like my service-based clients. Like I have one client that's a salon, so they incur their expenses, they do inventory orders every other day, they receive the money up front for their services, so they choose to keep their books on a cash basis. Whereas like my accounting firm, we don't receive we invoice you after services are performed, so we want to recognize all of our revenue in the prior month and match up our labor expenses to it. The benefit to doing accrual accounting is you get a bit more of a clear picture of being able to match your cost and your revenue. So it's a little bit more accurate, especially when it comes to making managerial decisions. And when you're looking at a statement, typically you won't be able to tell unless it says. So usually if you run a report like out of QuickBooks, there will be a little footer that says report run on July 18th on an accrual basis or on a cash basis.
I have another question. Can you explain cost of goods a bit more? This person actually runs a landscape company and always thought that it meant things like the cost of the plants and materials that he resells to clients. Does it cover more things than that?
Sure. So it can, unfortunately, Craig did not do a very good job breaking down his cost of goods sold here. But it depends on how much information you want to glean from your financial report. So it can just be plants and mulch and materials, fertilizer. Very typically, you would also have your cost of goods labor expense. So if you're a one-man operation, but you want to see the impact, you can split your pay between your administrative time and your on-site time to see how that works. Fuel expenses are a big one, especially in this kind of industry where you have to travel. But really, the level of detail you want to see is going to be up to you. Uh, that's the short answer. It's really up to you on the how much you want to understand your ratios and what your profit margins are.
Can you give a quick example of the difference between a job expense and a cost of good?
Job expenses are cost of goods sold.
Well, it was under, you had job expenses under general expenses instead of the cost of goods.
This is how I honestly, I'm not quite sure. This is from the demo company in QuickBooks, so I'm not quite sure why they were breaking it out that way. I personally would not. Some of these expenses seem like they would be cost of goods sold to me.
Okay, thank you.
All right, so moving on to the balance sheet. This is an often overlooked financial statement, but it has a lot of great information. And it's something that you should keep an eye on because it can be a very quick indicator that something is not correct with your accounts. So this will provide a snapshot of the company's financial condition at a specific point in time from the beginning of your financial record keeping. So your profit and loss, if I'm looking at it for 2024, it's only going to tell me the information from January to June. Whereas the balance sheet will give me from the beginning of time to the end of June. The three components there are going to be your assets, your liabilities, and your equity. So assets are considered to be resources owned by the company that are expected to provide future benefits. So your current assets are going to be your bank accounts, your accounts receivable. So that is money due to you from clients. If you have any inventory, uh, undeposited funds, I'll touch on in a second, and then fixed assets. So assets, though they might cost a lot of money up front, like this truck that Craig bought, it will provide future benefits because you can always turn around and sell that truck if you need to. It adds value to your company. Undeposited funds is an account that we see with cash accounting, and this can often get out of hand if you're not careful or aren't regularly maintaining your books. So what this means is that you've gone into your accounting software and you've clicked on a client invoice and you said, yep, Mr. Smith has paid his invoice. However, you still have that check in your hand and it's undeposited. So until you go to the bank and deposit that check, it will sit here in undeposited funds. So it's always important to make sure that you tell your accounting software, hey, by the way, that check for $2,000 I was hanging on to, it's been moved to the bank. So you want to make sure that your undeposited funds account regularly zeroes out. Otherwise, it means that you've either lost a check or there's cash that maybe you've put into your wallet and you forgot about, and it just isn't accounted for appropriately. So undeposited funds is a tricky account that I often see getting away from my clients. Liabilities are the obligation that the company has to external parties, which result in outflows of resources, typically cash. So we have our accounts payable. So this is any bills that the company might have that they need to pay. All of your credit cards will be listed here, along with things like your other payables. So your Department of Revenue, your employee taxes, loan payables, and then you have your long-term liabilities, such as notes payable. So this is, a 10-year loan for $25,000. it's not within the first year. So current liabilities are paid within 12 months. Long-term liabilities are more than that. And then equity. Equity is what your company is worth. It is the total dollar amount that would be returned to the shareholders if the company was to be liquidated and all debts are paid off. So the equation for that is assets minus liabilities equal your equity. So in this case, we have negative equity. And when I have new clients come to me, one of the first things that I check when I'm doing their review is their equity negative? And if it is, why? And that's something that I want to dig into a little bit more. Because sometimes there is a reason for it, and other times it can be an indicator of something not being recorded properly. So opening balance equity is an account that my firm typically likes to get rid of. We'll roll it over into net income or retained earnings. Sorry, I meant retained earnings, not net income. Your retained earnings are going to be what your revenue was for all prior years, and your net income should tie directly to that number on your profit and loss statement for the same period and date. One thing that is not listed here, but is very, very common for small businesses, is an account that's called owner's pay and personal expense, members' draws, members' contributions, members' equity, something like that. And that's when it's your small business and you went out to dinner on the company card and it's not necessarily a business expense, but it needs to be accounted for somewhere. Or if you need to take $1,000 from the company, you're not taking a paycheck. It's an owner's draw. It's your company. You can have that money, but it needs to be recorded somewhere that makes sense. And the equity section is where that would be posted. So this is a comprehensive view of what your balance sheet should look like. You'll always have it set up with your assets on top, followed by your liabilities, and then finally your equity. It is a balance sheet because your assets should always balance to your total liabilities and equity. And if they don't, you have a big problem and it's very hard to record it in most accounting software and have it not balance. The software just doesn't like you doing it that way. But if you are manually keeping your books, that is something to be cognizant of. So what do you do with the balance sheet? So there are a few things that you can do with balance sheet analysis. And one of that is your liquidity analysis. So can you cover your short-term obligations with your short-term assets? So there's two quick ratios that you can do. One is called a quick ratio and the other one is the current ratio. So the current ratio in Craig's case is going to be your current assets divided by your current liabilities. A ratio above 1 indicates that you have sufficient assets to cover your obligations. So in this case, he has almost $11,000 in assets, but his current liabilities are about 7,000. So his ratio is 1.55, and his current operating says that yes, he can cover his obligations. Quick ratio is a little different, and this is one that we recommend to our clients who do have a lot of inventory. It's your current assets minus your inventory, which is then divided by your current liabilities. The reason I prefer this one in the case where clients have quite a bit of inventory is because you don't have to liquidate anything. So using a current ratio, you're assuming that if I need to pay my current obligations, I need to liquidate some or all of my inventory. But in this case, you'll be able to maintain inventory. It's still an asset to your company, but everything else will be taken into consideration in order to achieve that ratio. But same thing, if it's above 1, it should be sufficient to cover your obligations. The other one is your solvency analysis. So what is your company's reliance on debt? This is going to be a big one that is used by business lenders. So they will do a debt to equity ratio, or you'll do equity ratios to determine whether or not your company is a risk to lend to. So this is a big one that banks will use. So your debt to equity ratio is going to be your total, not your current, but your total liabilities divided by your shareholders' equity. So the lower the ratio, the stronger your equity position and the less of your reliance on debt. In Craig's case, his ratio is negative 4.18, which is not good. So when I say lower the ratio, I mean closer to zero. Um, so Craig has liabilities that are currently outnumbering his assets. Um, so he seems very risky to me. Uh, the other ratio is your equity ratio, which is your equity divided by your assets. And then in this case, the higher the ratio, the more financially stable your company is. So with Craig sitting at a negative 0.3, I would not want to lend to this company. It seems like they're high risk and there's a good chance of bankruptcy. Moving on to the statement of cash flow. This is a report that I find that a lot of accounting software can give you a decent template, but because cash flow is something that it can be updated every day unless you're maintaining your financial records in your accounting software daily. Sometimes there's external tools that you may find more useful to give you an idea of what your cash flow is at that day. Oftentimes you can do a lot of forecasting that way as well. So this summarizes the cash coming in and out of your company at any given time and can determine the right time to make major financial decisions. So there's three key components, which are your operating, investing, and financing activities. So here is an example of Craig's cash flow statement as of today. So your operating activities are going to be your cash received, your cash paid to suppliers and employees, your operating expenses. So you'll take your net income from your profit and loss statement. It should come directly from that report. And then you'll have your information from your balance sheet. So your accounts receivable, your inventory assets, your payables, your credit card, and then any loan payables that you might have documented on your balance sheet. When you're looking at your operating activities, a positive number means that the company is generating sufficient cash from the core business without external funding. Negative could mean that the company is struggling to make enough cash, and this might run into liquidity issues later on. So in this case, Craig is still operating with a positive number, not much, but his operating activities are at, it looks like, $253. The next section is going to be your investing activities. So what are you doing for the long-term financial health of your company? So this is going to be where you record purchases of property or equipment. If you lend money out, like if you have an employee loan program that you have, or if you're collecting loans. So a negative number indicates that the company is investing in its future growth. So here we have Craig who's purchased a truck, and that shows that he has invested this money to the future. Positive can mean that they are trying to restructure or are going through other attempts at raising cash. That's not always true. That's why understanding your balance sheet is important to see what that full story might be. And then your financing activities. These are the transactions that the company's owners and creditors, like the issuance of company stock, repaying loans, owners' investments, that's where those types of activities are recorded. So a positive number means that the company is raising funds through debt or equity. So common stock, if you have stock options that investors are putting into the company, large notes payables, those are investments. If it is negative, that isn't always a bad thing either. A negative number for your financing activities could mean that you're doing very well financially and you're in the process of paying those items back. So if you're actively reducing your liabilities in order to give value to your shareholders, then your financing activities number may be negative. So the cash at the end of this period, once we take everything into consideration, we have about $4,000 to play with.
Would a website redesign be considered an investing activity?
Potentially. That it can. Depends on how that website design I guess is amortized. Typically I would say that that would probably be an expense though. It's a one-time thing. It's not like a patent expense or something that you can consider an asset.
Great, that makes sense. Okay,
Okay.
we'll hit more questions later.
Okay. Integrating your financial statements. So no one statement gives us the full picture of the company's health. As we looked at today, our profit and loss is going to show our profitability, our revenue trends, and our expense management to help us understand where our money is going. What bucket do we see most of our expenses falling into? Our balance sheet is going to help us with our asset management, our liquidity and our solvency. And then our cash flow is how much cash are we generating? How much cash are we using? And what is the liquidity of the business? So there are a few different ways that we can put all three of these together. So if you want to assess the profitability and the performance of your company, you would use all three statements and you would use the P&L to analyze your revenue and expenses to understand your profitability. Then you would turn to your balance sheet and look at your retained earnings to see what that cumulative impact is over time. So for a lot of my clients, our firm started in 2018. We really started to pick up speed in 2019, and then 2020 hit. So with COVID, a lot of our small businesses that had only been in operation for 6 months or a year, all of a sudden their financials were very, very difficult to interpret because you had this huge external force that was impacting their P&L. So all of a sudden, their business closed for 3 or 6 months. So you have this huge drop in profitability. But the balance sheet shows in retained earnings that you were doing well prior to that point. So just the P&L wasn't truly accurate to assess the profitability and performance of that business. But over time, when you add the balance sheet in, you can see that those retained earnings from prior to the events, they were doing well. So there's money in the bank there. And then your cash flow, you can check the cash flow from your operating activities to see if the profits are being converted into cash, or if once you pay out all of your balance sheet liabilities that are also included there, are you running into a deficit? So that's how those three interplay when trying to understand your performance. It can also be a great tool to do growth and investment analysis. So you can evaluate your revenue growth and your expense management over time. So again, I would like to either run it by year if you have multiple years of history, or you can run it by month to see how you're trending and what your growth patterns seem to be. And are you managing your expenses in a right way, or are there areas where you can cut, or is there some room for additional expenses that might allow you to grow in the future? Your balance sheet, you would review your investments and your long-term assets and the use of your debt or equity for financing. So how many loans do I have, or how many investors have given me money, or what kind of equity do I have? Do I have a large amount of debt? that will help me grow, and what kind of assets have I purchased land that will pay off tenfold over time. And then your cash flow would be to be analyzed for your capital expenditures and cash received from your financing activities. Um, a lot of our clients will use a budget. We'll create a budget towards the end of the year and then determine what their cash flow might look like for the next year and plan major capex purchases. So if you want to buy a new truck, when might be the right time based on your budget or based on past performance and review of these three statements together. Cash flow management. Cash is king, and as a small business, you definitely need to know where your money is at all times. So being able to identify major income and expense items that affect profitability, like we reviewed earlier, is very important. Your balance sheet, being able to look at changes in your working capital, such as your accounts receivable, your inventory, your payables, all these things impact your cash flow. And then, of course, your cash flow will track your operations, investments, and financing to understand cash management from a higher level. So, common mistakes to avoid. These are things that I see all the time. Ignoring the balance sheet. Hopefully, I've impressed upon you today the importance of looking at all of your financial statements. If your accounts on your balance sheet don't make sense or are telling a very different story than your profit and loss, this can be an indicator that either something is not being maintained correctly or your business might be running into some future problems and you want to be able to anticipate that. Operating the business by the bank balance versus by understanding and interpreting your financial statements. As I mentioned before, a lot of small business owners say, well, I got money in the bank, so I can afford it. When they might not be taking into consideration your accounts payable, all the bills that are due, or the amount of your loans and the payments that might need to be applied there. So there are things that aren't immediately recognized as an expense, but still need to be considered before you make large purchases. Not keeping timely records is a huge one. I briefly mentioned when we were looking at the cash flow statement that that's only as accurate as your records. So if you haven't entered any of your expenses or revenue from the past 4 months, you have no idea what you're looking at. And a lot of times in small business, this is where it is important to get a professional on your side. You're busy being a landscaper, you're busy being a salon owner, you're busy doing what you do best. And accounting can often fall to the wayside because it's not super fun for most small business owners. And it can often be left behind. And this can lead to problems because you can't anticipate any pitfalls that might be coming up. And on the other side, you might not see potential opportunities there either. Small businesses, the commingling of personal and business expenses is a tough one. You want to make sure when you are looking at your financial statements, if you ever take it to an angel investor or to a bank and you want to show the value of your company, you want to make sure that, you know, your personal grocery bill isn't showing your operating expense, because then your net income is artificially lower when it has nothing to do with the business's operation that you went to the grocery store. That's personal. So being very cognizant to keep separate bank accounts, separate credit cards, and not posting personal expenses to the profit and loss is a big one. Reconciliation of balance sheet accounts is a huge oversight. Often because people aren't looking at their balance sheet, they don't necessarily know that they need to be reconciling these accounts. So if you're not looking at your bank balance on your balance sheet, you can have $1 million in the bank when in actuality you might only have 100,000. So that variance there means that there are expenses or income posted in other accounts that aren't true. So your source of truth on your books is making sure that your banks are reconciled. And if all your bank accounts are reconciled and your credit card accounts are reconciled, that means that all of your income and expenses are recorded and there's no duplication. And then finally, is the over or under usage of your accounting software. Um, Under usage is, I think, pretty self-explanatory, letting months of data build up and not being entered. But over usage of accounting software can be an issue too. And what I mean by that is a lot of our small business accounting software options now have really great AI integrated tools. And I have seen a huge uptick in issues resulting from automation in the past year or so. Over reliance on QuickBooks to code things correctly can lead to a lot of problems. There are great tools and there are rules that you can set up, but I still strongly recommend the human touch, being able to put your eyes on it to make sure that it makes sense. And even if you want to try to fully automate everything, manually reviewing your transactions or your financial statements and doing that gut check that I mentioned earlier will help you from getting into a situation where QuickBooks just kind of takes on a mind of its own and starts applying things to crazy places that don't make sense for you. It can lead to a lot of cleanup and inaccuracy. So I do very much still have a human element to it. Even though these tools are marketed as a great time saver, it can lead to bigger issues down the road. And that's what I got for you today. Does anybody have any additional questions?
Yes, I have a list of questions here.
Sure.
I think this person is a nonprofit based on a previous question. Would a $2,000 computer and or other supplies you have for events and marketings be included in a fixed asset?
We recommend setting a fixed asset level at either $2,000 or $2,500. So your accounting policies and procedures are key to making sure that there's consistency in your bookkeeping. You don't want to set it too low or else it gets cumbersome. So yeah, things like computers, absolutely. It's good practice. And then marketing supplies, that kind of depends. So if like you have trade show materials and you purchased a backdrop or something like that, that could definitely be considered an asset. If you're printing off rack cards for a specific event, that would be a direct expense.
Okay. Um, this one is, since we are still operating out of the large loan we got during COVID, what should we focus on to see how good or bad we are doing? It feels like we are just doing poorly because we're still living from the loan.
Sure. So that's where you can take a look at your profit and loss statement and see how you're trending there. So your loan should be on your balance sheet, but if you're continuing to see improvements on your net income, that should be an indicator that you're trending in the right direction.
Would the cost of health insurance be considered a business or personal expense? It's just for me and my family as a solo employee.
Uh, that is something that you can choose how you like to record it, but fringe benefits are very often considered part of your operating expense.
Okay. I'm currently using online QuickBooks, but would like to explore other options. Any suggestions?
Sure. One of the pieces of software that I very much like, especially for smaller businesses that don't need a lot of flashy features upfront, is Zero, Xero. I believe they're based out of Australia, but they do have offices in the United States. Their customer service is fantastic. And the thing that I like most is that they are significantly cheaper than the lower versions of QuickBooks. It has most of the same functionality. You still have all of your reporting, all your reconciliations. There's a lot of automation there. You can invoice and receive payments from it. It isn't as pretty or as well known as QuickBooks Online. For larger options, if you're trying to scale up, there's numerous options. and feel free to email me if you like additional ones, but typically for online cloud-based solutions, um, if QuickBooks seems a little expensive or a little much, Xero has been our go-to recommendation.
My accountant charges a flat fee to do my taxes. Should I expect that to include a regular meeting with me to review financials? My bookkeeper reviews QuickBook entries with me every month, but I don't feel like anyone is helping me look at the big picture.
I can't speak to the pricing structure of your tax accountant, but that's definitely something I would ask for. Being able to understand your company's financial health is critical to your operations. So I would push for that. And if you are in a place with your tax accountant where they're doing projections, usually those start at the end of Q2 or somewhere around Q3, you can start to do those reviews early because the tax accountant probably isn't going to want to sit down with you in April to talk through it.
As a board chair of a nonprofit, what should I keep my eye on when it comes to financial statements?
Uh, that could be a presentation in and of itself. So if you want to shoot me an email, I'd be happy to talk to you about that. But again, it's just going to be managing those grant costs, making sure that you should be keeping your books on an accrual basis. So it's going to be the same. You're going to want to make sure that your expenses aren't aren't overreaching what your grant program or your allowances are.
Is there a form or way to extract the data to create a seller's discretionary earnings for someone selling their business?
Uh, could you elaborate a little bit more on that question? Like, is there an export feature in QuickBooks Online?
Okay, well, we'll wait for that reply.
Sure.
There was another one here. Let me find it. What do we need to know about general accounting practice standards? How do we ensure that we are following them when creating a P&L statement without using QuickBooks?
Sure. So I would strongly recommend using some software just because it can be very cumbersome to try to do it in just Excel and inside a worksheet. But things to be cognizant of if you are manually keeping your records are your documentation. You're going to want to be able to prove that all of your expenses are properly recorded. You're still going to want to go through and do a manual reconciliation to make sure that all of your bank expenses and all of your revenue is properly captured. Um, that is where I find the software to be very helpful is you can upload your statements and then there are tools to help you reconcile. Um, that that is the difficulty.
Okay, I have more information on the seller's discretionary earnings. They are asking about a way to extract the data in a report in QuickBooks.
Typically, no, QuickBooks does not have a consolidated report. But if you go under your reports, you can create a customized management report package, and it has a pretty cover sheet, and you can add the statements in there. So you can add your profit and loss in your balance sheet, your cash flow. If there's any AR or AP that they want disclosed, you can put those all into a consolidated report.
Do you know if it's easy to move your data from QuickBooks to Xero? Is it easily?
Uh, it's it's not overly difficult. It really depends on the quantity. Typically it goes smoothly, especially if you don't have too much data. But I do recommend, even if you are fairly confident or tech savvy, I'd always consult a professional just to do a quick reconciliation and make sure everything came over correctly.
How necessary are financial statements when buying a business through an asset sale?
It's definitely something you want to take a look at. There can be things hidden in the financial reports. If you're not familiar with how to read them, they can sneak some things by you. So you're going to want to make sure that you take a look at that balance sheet.
Okay, I think I've hit everybody's questions. Um, yeah, I'm pretty sure I've hit them all. So, did you want, yeah, there, I was still going
Sure.
to ask you.
So So this first link here is to that test drive to Craig's landscaping and design. If you want to go into QuickBooks and play around, see what it looks like. Um, Investopedia is a great resource for defining things in English. I very much like this website. I've linked the financial terms dictionary. It puts things in plain English instead of reading some of those things that can really like bog you down. So it's a great place to start. They also have other great articles. And then of course, my firm has a blog and we like to post things that people have come to us with questions about, so other people might have those resources available. So if there is something that you would like to see and it's not on our site, you can always shoot us an email, and we're always thankful for ideas on what we can write about. So we do have additional information there. And
Can you copy paste those into chat, please?
I can. I will.
Okay. Yeah, no problem.
um, And then here is my contact information. If you reach out to us at our info@smb.cpa email address, please put into the description that you attended our score session today, and we'll be happy to get back to you. One of our accountants there. Our firm is very small, so we're all familiar, and we want to make sure that the score participants get additional mentoring and get all their questions answered. So you'll be able to reach out to us directly at that link.
And I just had a question for those resources. So I'll let you get those into the chat. Okay, great. I'll give everyone a few moments to snag those out of chat if you'd like to copy paste those out. And sure, I have that as well. Okay, I think that covers everything. Well, thank you so much, Morgan. And thank you everyone for joining us. And we hope to see you again soon on another SCORE webinar. Have a great rest of your day, everybody.
Thank you guys.